FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You're listening to the Financial Survival Network. I'm Kerry Lutz. And if you haven't heard this person before, you need to listen to him now. Martin Armstrong, originator of the economic confidence model, the forecaster's forecaster. While others have been saying that the stock market is a bubble and it's going to collapse any moment, Martin's been saying that prices, that indices are going to advance ever higher. Well, who's been right over the past year? Look at the numbers. You decide. Martin, welcome back.
Oh, well, thank you for inviting me, Kerry.
Yeah. And hey, Dow over 17,000, S&P 500 over 2,000. You're not surprised, are you?
No, people have to understand that most of the analysis that you listen to is domestic, and therefore they keep judging it by the way it was before. And this is a different atmosphere. This is basically, you have capital flows that are coming to the United States, and there's no place else to go. You basically wiped out all the currencies of Europe, and you have the euro. And the euros, France has just fired all its government. It's really, really going down the chutes really pretty bad. And Britain is not doing so great, but it's not a big enough economy to absorb a lot of money. Neither is Canada nor is Australia. So if you're talking about large-scale pension money around the world, in the U.S. it's about $19 trillion. Where do you put it? And there isn't an avenue for this money to go. You're not going to go to China and buy yuan. You're not going to go to Russia and buy rubles. So unfortunately, by default, it's becoming the dollar. And that is what is really behind this. And the capital flows that are coming in is going in this direction. Now, further example of this is the central banks. And what you have is largely with them is that they have reserves. Now, when you eliminate all the European currencies and you got the euro, their problem is diversification. So they have been actually buying equities. They have nothing else to do. It's either dollars or they have to buy something tangible. And so they've been buying equities. Europe in particular has been doing it, and the Swiss have got a huge problem because they've been pegging the Swiss franc to the euro. So they start diversifying into Canadian dollar, Australian dollar, trying to do something. But everybody's herded into dollars. And that's why the stock market is still very viable. Sure, we're going to have little corrections here and there. We'll probably come back down again, I would say, after Labor Day. But there'll be buying opportunities again. And this market is nowhere close to a bubble. If you just pull out charts of all the bubble tops, 29, 87, whatever, and they give you one shot at selling the high. They don't give you 15 shots. So I don't know, I guess these people that keep saying all this stuff, they're not real traders or something. But anybody that's been a real trader over the years knows that, when there's a major high or a major low, that's it. You got one opportunity to do it. After that, it's done. And you wrote an article about margin debt because a lot of analysts out there have said 3% of GDP, that's what the margin debt is up to. My God, another sign of a bubble. And you said, doesn't matter. We're in a different paradigm now, right? Yeah, you don't see the retail clients are out. So it's not, margin from retail that's up there dramatically. What we have is interest rates are exceptionally low. You can actually earn higher dividends in some of them. If you can collect 5, 6, 7%, in interest and a dividend, that's pretty good return on your money. So it's not a speculative bubble as people, just looking at the margin numbers. It's, fine. You're looking at it in the nominal terms as well, and it's not really that big of a deal because the retail market is not in. So it's not a frothing bubble as it was in 2000.
So I'm a retail investor. I got 10, 15,000 to play this market to the peak, which you said probably somewhere next year, third quarter. How do I do it?
I would look for, basically a dip. I think the S&P will probably go up to try and test the 3,000 area. The S&P will lead a little bit more now than the Dow, and that is reflecting a shift from pure institutional to a little bit broader market. And the NASDAQ, has done percentage-wise the best return because it fell the most. That will eventually make new highs, but we're not looking at percentage-wise above the 2000 high dramatically as you are with the S&P or even the Dow. But I would say honestly that you have to look at this market objectively and understand that this is capital flows. And if you just look back at how things develop, the more geopolitical problems they have over in Europe, capital then flees Europe and comes here. It's got to park someplace. But then we have a problem of sovereign debt. And you have in Germany, they're talking about adding a 5% tax surcharge now to pay for the failing municipals. About half their municipal governments are like Detroit. They're bankrupt. And in the United States, we're not really that far behind because what's happened is the idea of how you run government is fundamentally flawed. You take a small town, they have 20 policemen, 10 retire. Now, they didn't fund their pensions, so they always assumed that the tax pit was endless. So they still have to pay them. But now they have to hire 10 people to replace them. So the cost of government has been rising exponentially. And the whole problem is what I've said. I don't think that there should be, I think government should privatize everything because at least if they promise you a pension, it's going to be there. When he who makes the rules promises he can change the rules anytime he wants. So that's the sad fact of it. So I think people with government pensions are finding it stressful, and they're going to find it a lot more stressful over the next 5 years. So, and it's everywhere, absolutely everywhere.
Yeah. And yeah, that's inevitable. We've been talking about that already for years as well. And, you can't put 10 pounds in a 5-pound bag and expect to have a good outcome, can you?
No. And although a lot of the gold promoters have been, talking about the German hyperinflation and stuff like that, what they fail to tell people is that, okay, fine, when you had the German hyperinflation and they came out with a new currency, what was it backed by? It wasn't gold. It was backed by real estate.
Right.
And
the rent
everything goes up. All tangible things go up. All right. So you will see when we get to the point where the confidence in government debt begins to really collapse, and we're starting that in Europe, but eventually it will spread as a contagion to here as well. When that begins to happen, then you will see actually gold rise with the stock market. Okay, that's when everything goes up. Anything on the opposite side of government rises. So I get a lot of questions. What do you think will survive when the euro collapses? Basically, your tangible assets like real estate, etc. As long as you still have a society that functions, that will be okay. Rather than into a Mad Max event, But as long as we stay away from the Mad Max, then real estate will survive. It just is redenominated in whatever new currency you end up with.
Yeah, and we will wind up with a new currency eventually, won't we?
I think that's basically historically there's no other way out for government. I mean, this is what they've always done. They're preparing for it already with this electronic currency that's coming. I mean, if you just look in the you can pick up a catalog or go on eBay, you'll probably find some still offered maybe. But you can buy $10,000 notes from 1934. They're still legal tender, etc. But $10,000 notes. Now this is when a Cadillac was $600, so it was a lot of money. Today we have the largest bills $100. Why? Because largely they have known all along, and their objective is to get rid of cash. And for two reasons. One, they think that if everything's electronic, then they get to collect every tax dollar possible.
Yeah.
And it's never that they spend too much. They figure that people cheat too much. And that's the way it is. When they start these government investigations with every crash or whatever, nobody ever starts with, did we do anything? It's, what did you do?
Yeah.
So you're never going to get at the proper solution for any of this stuff when the people that investigate never investigate starting objectively, which includes them.
Yeah, of course. And we see that over and over again. And in fact, it's so fascinating because we're seeing in the U.S. the death of currency. Martin, used to be, you went to an ATM machine at any too big to fail bank and you got out $1,000, which you could do in New York, $2,000, and they were brand new Federal Reserve notes. You go today and they are these beat up notes that are basically fit for the garbage. They should be burned, and they're just not putting new notes into the system. To me, that is the tip off that we're getting ready for something, because most people, recent survey, I think it was by bankrate.com, that 40% of the people carry no cash or under $50 in their pocket, and they just don't use currency anymore. And I don't know if it's a good trend or not, but once we go purely digital, then there really are no constraints on the money supply, on credit, because every dollar you spend winds up getting leveraged, whatever the Federal Reserve says they can leverage it, right?
Well, it's that's only one side of it, but the other side, which I find much more dangerous, is the taxation level. And once everything's in there, and you can't even have a bank run.
Yeah, that's impossible.
You go up to the bank and you say, "Here, put everything on a CD-ROM." What?
Yeah, give me a debit card, or so
what do you do?
Take it to another bank.
It's the whole thing changes. Everything changes once you eliminate the cash, and you see it in Europe. I mean, just over the last 2 years, when I go to Switzerland, I could get 1,000 Swiss francs out of an ATM, and now it's 500. You go to Paris, it's 200 euros. I mean, you can't even buy dinner for 200. You're lucky if you can get a hotel room for that. So it's now illegal to pay for a hotel room in Europe for more than 1,000 euros in cash. So they're trying to eliminate cash every possible way, and it's all for taxes.
Yeah. Yep. And it's such a great example there. Look, you go to Starbucks and they got a tip jar, and my guesstimate is that, there's 10, 12,000 Starbucks in the U.S., $300 a day going through there. It's $1 billion a year. They withhold a little bit, but really the government's not getting its quote unquote fair share. Now they've got an app that allows you to give a tip with the app, and it all gets accounted for. And you see the day coming when the tip jar is going to be eliminated, and you'll use the virtual tip jar, and the government gets its fair share of every dollar you tip. And that's going to be everywhere, isn't it? Yeah, I mean, that is their goal. And they have, their perspective is they're not the problem, you are. And so as long as they're going to have that kind of an attitude,
that is the direction that they're moving in. And I mean, even with the militarization of the police, etc., they know they have problems coming. I mean, historically, the United States has always looked at what goes down in Europe, and they figure like fashion eventually comes here. And that's very true. And you're seeing a lot more riots in Italy. You had the pitchfork riots, and when you start seeing the social programs decline here, and I mean Social Security, everything across the board of people relying upon government, regardless of what program it is, that's what's getting cut back. And it's as you're doing that, it's getting to be really bad. What Obama's done on the healthcare thing is like unbelievable. I mean, my personal healthcare is going up 300%, and that's it. And so it's just amazing. And then he's delayed the corporate tax, which they're fighting over now, but he wants to put that in when he leaves. Effectively, you'll then have a restraint on companies, and you either then have to pay for all this outrageous health care if you have 50 or more, or you don't. If you have more than 50, you fire if you can get under.
Mm-hmm.
Or you find companies splitting apart into separate companies so they don't go up over 50.
Yeah. Yep.
So
it's all about
very, very detrimental to what he's done. And then he puts in the Cadillac tax. So then you're going to be taxed on whatever benefits you do get.
Mm-hmm. Yep. And that's your government in action and all sorts of negative incentives. It's amazing. I was at a conference last week, and for people that don't know anything about economics and business, this guy was saying that really Freakonomics was an eye-opener book to him, and he really learned about how to run a business from Freakonomics. And I kind of scratched my head thinking, it was an entertaining book, and it wasn't anything earth-shattering to me. And then it occurred to me, well, if you've been schooled in socialism and you don't understand incentives and disincentives, then you read Freakonomics, and it's an eye-opener where, you're getting paid to have kids or paid not to have kids. And all of a sudden, if you really kind of think about economics, it's really all about incentives. And all of a sudden, it does kind of change your attitude. But
they do not understand it. And just bring it down to the school. If they said it in school, okay, fine. To be fair, everybody's going to get the same grade, whether you study, show up, or not. And then watch what happens.
Yeah.
The people that do produce are going to say, well, why should I bother?
Mm-hmm.
Because if I don't even show up, I'm going to get the same grade as if I did work. So, you can't have, these ideas sound very nice, whatever, but, in practical sense, you're trying to change humanity.
Yeah.
And that's just simply the way it is.
Doesn't work. Never has. I mean, and then you just look at what's happening where government tries to run things, micromanage it. Detroit, look at Atlantic City, what's happening there with the casinos, because it was a tightly regulated, micromanaged by government. And now it's a competitive industry, casinos all over the country. There's not just two markets anymore. There's dozens of markets, and Atlantic City can't compete. And they're closing up. They're closing up shop. Perfect example.
One of the brand new casinos there shutting down.
Yeah. And even in Connecticut, where the tribes had a monopoly, Foxwoods, they're in distress. And they just don't really get it. So one of the things people have asked about is, the concept of Bitcoin. You've said that the government can pretty much shut it down at will, but China hasn't exactly been able to shut it down, when they've made efforts to shut it down in the past.
Well, basically, we had a similar situation in the late 1970s when futures were starting. Everybody was getting involved into tax straddles. What you did was, if you wanted to move your money from this year to the next year, so you didn't have to pay taxes, and gold was going up, for example, then you sold gold in December and you bought gold in February. All right, so it was a straddle. And so you would take the loss on the December contract, which was now, and then the profit would be there in February to offset it. You kept moving it forward. Then the IRS figured it out.
Right.
And then the IRS went after everybody and charged them interest and penalties and all kinds of stuff. And some of the brokerage houses that were marketing it, had to pay huge fines. And Bitcoin is the same kind of problem, because a lot of people think that they can use Bitcoin and, gee, it's all tax-free or whatever. That's for now.
Yeah.
And when they are ready, and the money just keeps accruing to them. And, interest and penalties are outrageous. So when you move to an electronic currency, I don't see how Bitcoin is going to be able to survive. They can legally just shut it down anytime they want. And they can just walk in offices and take stuff. I mean, look at the NSA. They know everything that everybody's been doing on Bitcoin and who has it.
Sure. Yeah, makes sense. And, hey, we will see what happens. But, hey, when we return, let's talk about precious metals, where that market's heading, and, hey, what's happening with the East versus West, and how the U.S. is destroying the economic system on the Financial Survival Network.
FSN Radio. It's all about what's next.
Every day, the Financial Survival Network reaches tens of thousands of listeners and would like to reach thousands more. By adding a video channel and more show hosts, we think we can make that happen. But we need your help. If you're a regular listener of FSN and would like to help, please go to clubfsn.com to donate monthly from $1 to $100. The choice is yours, but every bit counts. There are premiums available for you, but the biggest one by far is you helping FSN get the message out to your friends and family to be prepared, hopeful, and ready. That's what FSN is all about, and that's why you listen. So go to clubfsn.com and help us get the word out before it's too late.
The Financial Survival Network. It's all about what's next.
If you haven't been listening, we're here with Martin Armstrong, the forecaster's forecaster, and Martin's made some remarkable calls in the past. He hasn't flinched from his current bullish forecast of the stock market and where it's heading, based largely on his economic confidence model and the flow of funds, that basically there is no option but to put your money into the stock market, especially if you're a large institution. So, Martin, gold and silver been in a 3-year bear market, basically. They staying there? When are they going up? It
will probably turn back up, I would say, in early 2016. It's not a hedge against inflation, and people have to understand this. Most of the stuff that the gold promoters have been saying is just fundamentally wrong, and it does not, hold up to the facts. And the fiat money, etc. Money's always fiat. It has always been since the beginning of time. And that's why they made it illegal for anybody else to produce money. Why? Because the government made a profit off it. They could take, $5 worth of gold and call it $10. And that's fiat, and that's the way it was. So there are more important issues that you have to understand. And gold has been confusing to a lot of people, because when it is a gold standard, then it declines when a stock market rises. Why? Because its purchasing power is less and less and less. And these people that tend to say, oh, money's got to be tangible, etc., and a store of value, they don't quite understand what they're saying. If money is a store of value, then you're saying that money doesn't decline. If it doesn't decline, then assets cannot rise, and you cannot get a wage increase. That's communism.
Mm-hmm.
Everything's flatlined. So, money has never been a store of value, regardless of what it is. And they confuse the fact that, there's a gold standard, not a gold standard. We're not on a gold standard right now. And when did gold really take off? When our economic confidence model turned down. Okay, then it rallied sharply from 07 into 11. Now, why? Because it was basically the opposite side of the government. All right, so it's not inflation. It actually rose during deflationary. And this is what we have to understand, that it is the hedge against government. All right, and so we will probably see gold rise out of 16 going into 17, 18, 19. And that is when we're going to see the rally. Largely, people will then look back at gold when other things are uncertain. As long as the economy is doing well and you can listen to all the, everything, bubbles or whatever. Well, when assets rise, that's basically what's going on. So what we're looking at is what we call a cycle inversion, and that has been developing. So this last rally we got came when our economic confidence model went down. And the 1980 rally, it rose with the model. So that was an inflationary boom. Everybody was upset buying, toilet paper, hoarding it, and whatever, and oil in those days. All right, now we're into a sovereign debt. And what do you do with your money when you can't trust the banks, you can't trust the government, bonds, etc.? That's where gold comes in. All right, it's not the hedge against inflation. Sorry to say, but if you bought $1,000 worth of gold and $1,000 worth of Dow stocks in 1980, you made $17,000 on the stocks, and you're about breaking even on gold. So after inflation, you're probably about 30% behind.
Mm-hmm.
So that didn't really pan out. What is going to happen in commodities historically, they surge. All right, it's not a trend, not a linear trend like a 747 landing or taking off, whatever. These things burst, and when they burst, it's all at one time.
Right.
So you get, for example, gold reached 270 in 1974, falls to 100 in 1976. It goes finally up to 400 in December of 1979. The last few weeks into January 21st, it goes from 400 to 875.
Mm-hmm.
This is the way these things trade, okay? And you have to understand it's going to be a burst. It's not going to be this nice, steady return.
So buckle your seatbelts, huh?
Pretty much, yes. So I think after 16 is when you're going to start seeing more geopolitical concerns, uncertainty on the debt side. Municipals are going to have a lot more trouble. So effectively, people at that point, the average person, will be looking more to gold. And if we can stay away from the gold promoting nonsense that has hurt a lot of people, and has really given a bad reputation to gold.
Mm-hmm.
And then if we get to that level where it's just seen as, yes, this is a viable investment, it's not the end of the world type thing, then you're going to see it, take off. But to take off, it needs a broader market, just not the same, few percent of people buying.
Right. So.
And once you get to that level, then you'll see it more on a sustained basis and really taking off. And that's why I suggest to people that, you should have some gold, but I would, do gold coins. like $20 gold pieces, $10 gold pieces, common dates, not MS-65s and stuff like that.
Right. Numismatics.
Yeah, just the standard, bullion type things. You don't want to get into opinions. Oh, there's a little scratch here. So I think it's a 64 instead of 65, and that takes off $500 or something.
Sure.
Stay away from that kind of stuff. But that is what we're really looking at. It's you have to be looking at, as I said, in Germany, they're looking at putting a 5% tax because 50% of municipals are bankrupt.
Right.
They're not ready for reform yet. These people are trying desperately to hold on to power.
Anything but, right?
Yeah, and it's not going to work.
Sure.
All right, the system is fundamentally, really screwed.
Flawed.
And eventually, we're looking at, the financial capital of the world has always moved. It has never remained in one place. It moves from empire to empire to empire. And it was with Britain up until World War I. The United States, in 1896, J.P. Morgan had to organize a loan to bail out the Treasury because it was bankrupt.
Right.
So we go from bankruptcy to the world's number one financial capital by 1914.
Mm-hmm.
That's a pretty good run.
Yeah, but it's coming to an end, right?
Then we had World War II. Mm-hmm. At the end of World War II, we ended up with 76% of the world gold reserves. Now, this is important. We're about to publish a report on this, on the electronic currency, et cetera. And we're laying out all the research on this and what it shows. And personally, I think people have often asked me why was JFK assassinated. I think it's basically because what he understood what the problem was. Mm-hmm. He gave several speeches on it, which goes over the head of most people. They want to get into the conspiracies of the CIA and all the rest of the stuff. But he said the United States can end its trade, its current account deficit any time it wants. All it has to do is stop militarizing the world.
Mm-hmm.
Eisenhower, when he was leaving office,
sure,
said the same thing.
We know
military
that
complex.
We know
if
that
you
one.
look at the numbers, okay, United States did not lose its financial position because we're buying pink umbrellas from Thailand, for drinks.
Right.
It was because of military.
Sure.
We were building bases everywhere, and that cost a lot of money. And we put people everywhere, and that basically sent dollars out of the country.
800 by last, over 800 military bases around the globe at last count, and that's what we know about, right?
Well, that's what Kennedy actually stood up and said. We can stop this and save Bretton Woods and the dollar if we curtail military.
Yeah.
I think that's more of an issue for taking somebody out than anything else.
That's a sure way to make enemies.
Come out,
right?
then you had Vietnam after that. But
yeah, and purportedly he wanted to pull the troops out of Vietnam, and hey, also oil depletion allowance. There was a whole bunch of stuff.
We have, I collected all his transcripts from his debates. The third debate, they actually asked him on TV with Nixon about the dollar.
Yeah.
And he said he gave this outline about the military. That is the first time gold rallied. People might not know it, but in the markets, in the cash markets, gold went from $35 to $40, like that.
Kidding.
On that speech.
Really?
It was the panic of 1960, and it's not really known about too much because there wasn't a financial market per se.
Amazing.
But that was the first time gold went up, and it was the first break, and it was 1960. So that was the first, shot across the bow that Bretton Woods was collapsing.
Amazing.
By 63, they had to take, they came up and to eliminate silver. And 66, you start with a crisis at that point. By 68, you have a two-tier system developing with a free market of gold, one price in London and a separate price among central banks. That finally gave way by 1971, and that was Nixon closing the gold window. But then he was still demanding that negotiations, but then OPEC came and they got distracted between that and Watergate, and so we ended up with the floating exchange rate system.
Makes you wonder, go back in history, what would have happened. But obviously we don't have that luxury. But it's fascinating to think because, there's just so much that was going on at the time. And of course, you, the average American, were completely oblivious to it. There was no internet. Alternative sources of information were non-existent. You got it from the major media. It was all but shut out. And, you can play back that parting speech of Eisenhower, beware of the military-industrial complex. And it really was kind of meaningless back then. It's like, oh, okay. There were hundreds of military contractors. They didn't seem to be such a cohesive block. Now, you watch it and you say, oh my God, he was spot on, and look where we are now.
Well, people don't realize then after that, the third debate of Kennedy and Nixon in 1960, he says it right there and then. Yeah.
Shocking, huh?
Yep. Again, it goes over the head of most people. They don't, what's he talking military, it's the cost of funding it all.
Yeah. Yeah.
And we still haven't learned.
The cost of funding the empire. And, how do you pay for it all? The Romans never figured it out. And we sure haven't as well. So also in your model, talking about the balance of power moving from west to east. And, we really haven't talked about your system, Socrates, at all, but you put a lot of time and a huge amount of money into it. Just tell us about it a little bit.
Well, essentially, even like with the stock market right now, what really drives it? It's not the stock market by itself. It is the entire global economy. We're all connected. And every little movement on one side causes a reaction that ripples through the entire system. So it makes it really virtually impossible for any individual to do a forecast and be consistently right all the time. Mm-hmm. Because you can't forecast these things from opinion and well, what I think might happen, what not, et cetera. I mean, it's a lot more complicated. So right. What Socrates does is effectively we have every market in the world, every economy, every economic statistic, and it's largely following everything on a correlated basis. And it comes out largely with these forecasts, and the reason they've been consistent, I mean, if you look at it, we couldn't have been right on the stock market unless we were right on gold. So each thing filters into the next. So it's not a single forecast. It is the fact, okay, fine, a lot of people didn't like it. Then I said, all right, the stock market is going to, take off to make new highs. We said that and Barron's even covered that forecast in 2011. Mm-hmm. Said we're going off to new highs when we were at the lows.
Right.
And at the same time, we said, okay, fine, gold is peaking. And, of course, a lot of the gold promoters didn't like that. And, but everything is part and parcel of the next. So the stock market wouldn't have rallied if gold, had continued to go up. Because it continued to go up, you have to have the sentiment and the collapse in confidence. Once that turned, then the confidence was turning and the capital flows were turning. And what are you going to get is you get now the next thing. And that was the stock market. When you look at these bubbles, I would say the one thing that we were able to identify is that there's a bubble effectively every 8.6 years. It doesn't matter what it is. It's human nature wants to speculate on something. And so it's going to be commodities one time, real estate the next time, stock market next time, bonds next time. Then it reverses. Okay, we'll go back to commodities. It's one after the other. And I saw this, personally, when I was young. It was like there was a hitting in 66 and then 68 and then 70. And I said, oh, well, 66 was mutual funds crashed. I remember I had bought in Fidelity Trend, I think about $54 and watched it go to $7. And 68 hits again. And I said, forget all this stuff. Let me try real estate. That got hit. And I go, it doesn't matter what it is. Everything
sounds
goes
like the story of my life,
down.
Martin.
And so I began to see it. And then as I, was in the industry, we were doing a lot of business in Geneva, and then, okay, fine, going off to Japan. And I'm thinking, all right, fine, I don't really know anybody in Japan. And here I get over there, and basically everybody I knew that was in Geneva had moved over there following the money.
Right.
So, and then from Japan, then they went to Southeast Asia. So you could see how there's always this bubble. And it's, okay, this one's done. What's next? And Greece fell, okay? So then what happens? The capital looks around. Oh, gee, yeah, Greece was in trouble. Well, who else is next? Oh, look at Italy, Spain, Portugal. And then they go after them.
Right.
This is the way it is. And it's human nature that drives it.
Uh-huh.
So you're not going to get the, each bubble is going to be gold. Okay, gold, we had a good time. That was very nice. Done. Next, stock market. We then have to look at the point where confidence will then say, wait a minute, the problem is government. When that happens, then all things on the private side start to go up together.
Interesting.
And that's what we're waiting for.
It's fascinating. So really, where we're at now is the confidence in government, and Europe is ahead of the curve, but the U.S. is coming up behind. What about in Asia with China? Do those people really have confidence in their government to get them out of this mess? Can they possibly?
China is interesting. I've been to both, behind the Berlin Wall and to China. And there was a substantial difference between the psychology of communism and one versus the other. I often write about Stalinistic attitudes. In Russia, Stalin was paranoid. He was concerned about what you thought.
Yeah.
Okay, and children were taught, if your parents, ever talk about the state, turn them in.
Right.
The state is really your parent.
Yeah.
So he was more concerned with what people had to think. And this is why tens of millions of people were killed.
Sure, of course.
When you go to China, it was the tall poppy syndrome.
Mm-hmm.
And the poppy that grows taller than the rest gets its head cut off. As long as you stay with the pack, we don't care. So the difference was that China left intact the human nature of people. They didn't break apart the family bonds as they did so much in Russia. And the entrepreneurship sprung up like a spring. In Russia, you basically to oligarchy.
Mm-hmm.
And that was it. You still can't have somebody that opens up a restaurant in Moscow. I've always wanted to own one. Go ahead. They'll kill you.
Yeah.
So it's a different atmosphere. And this is why Russia, on a good day, is still half of what Japan is on a bad day, economically.
Right.
And China, on the other side, it's not that they believe in government. They really kind of ignore government, which is more or less a key component in survival. If you look at Southern Europe, the numbers are often, I would go to Italy and you looked at the numbers, you would think, my God, this country's got to be in a complete depression. And you go there, it was vibrant, whatever, and largely because people just ignored them.
Right.
They didn't pay taxes. Everything was in cash. And so, you saw the same thing in Ukraine, etc. People would have their own gardens. They didn't trust government. There were no government programs that they ever trusted. So people were more self-reliant. And this is more or less what I saw in China, that they were more self-reliant, whereas you go to Russia, what is a lot of the unrest and stuff, people want to be taken care of. I want it back the way it was. I don't have to work. I don't have to do anything. They just take care of me.
Good old days.
That's what they want.
They want the good old days back, huh?
Yeah, and so to them, it's a lot of them are basically saying it is the good old days of communism. And I knew people that bought companies in East Germany, and they thought, Germans are going to be able to really produce. And they found out it took East Germans to do the work of one West. And a lot of places went bankrupt.
And on that note, so take a look at Martin's site, armstrongeconomics.com. Got several postings daily explaining to you exactly what's happening with the economic confidence model, flow of funds, and how it affects you. And think about that. If the S&P is going up to 3,000 and the Dow's heading into the 20s and even the 30s, how that's going to affect you, and then where we head from there, because I guess it's going to hit the fan in the third quarter of next year. Right, Martin?
That's what it looks like.
So,
from there in the first quarter of 16 on some markets.
Right. So go over to financialsurvivalnetwork.com, find the link to Martin's site, sign up for a newsletter. We're active again with it. We're going to be having a webinar shortly. Martin, can't thank you enough for coming on. Have a happy holiday.
Oh, same to you. It's always a pleasure, Kerry.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.